Hey guys, what's happening? Eric here, Mr. Fired Up Wealth. Today I'm bringing you video number 4 in a series of 6 covering the stock market sectors. Today we're covering consumer staples and consumer discretionary. Now, if you're new to the channel, there were some videos before this that you missed, so you may want to go back. The very first video in the series was an introduction to kind of explain what this series is all about, covering the 11 sectors in the stock market. The first topic that we covered, the first video in the series of 6 then after that, was the financial sector, and then we did healthcare. Last week we did industrials and materials, those 2 sectors in the same video, and today we're covering 2 sectors again in the same video with consumer staples and consumer discretionary. So there are 5 criteria we're looking for. We're looking for DGIF, that's dividend growth investing for fired stocks. If you don't know what DGIF means, please go back to the previous videos. I don't want to repeat it here just in the interest of time. So today I'm covering some really good companies. There's 10 picks. There was probably 40 that could have been in here. So it was a kind of a difficult video to make, but you will see that the 10 that I picked actually make a lot of sense in terms of growth, not only dividend growth, but also the growth in the appreciation in the stock value. So we're focused on total growth, and that's what we want. We're trying to pick stocks in these sectors that have not only they're growing their dividend annually at a high rate, also are growing. The stock price is growing, and they've performed well over the last 10 years. We're looking at a 10-year annualized return. Now, of course, there's no guarantee that just because somebody had a 30% 10-year annualized return that they're going to get 30% again every year. With that said, though, it does show you that there's a proven track record of performance, especially if they're continuing to grow their dividend. And then what we do is we qualify the company and then we dig into it further. So we're not just using a screener and finding companies that fit in those 5 parameters and going out and buying them. We're using the screener to find companies that fit into the categories we're looking for. And then we go investigate further. We look at growth trends, potential growth drivers. We're looking at the financials. We're listening to earnings reports. We're checking out the management. We're looking online to see if any risks that are out there. Maybe even looking at reviews, like going on Facebook and seeing what customers think of these companies. If there's a lot of complaints, what the employees think on glass window, glass door. You can go and actually look and see what the employees review the CEO. What they think about working at the company. There's a lot of things that I do when I'm investing in a company, especially if I'm going to buy a full position in a company that I consider not speculative. And anything in DGIF is not usually going to be speculative. It's going to be something that I'm going to buy and hold for the next 5 or 10 years. So these picks are meant to be buy and hold type stocks that you'll hold for hopefully the next decade. Of course, if the story changes, then there's times where you do have to bail on a stock and sell soon. So with that said, I am excited to get this video started. If you have not subscribed, please do. The bottom right-hand corner, there's a little subscribe button. There's also a little bell you need to click, and you'll want to do that because there's 2 more videos in this series. Next week, I'm going to cover 3 sectors in one video. It's going to be REITs, energy, and utilities. And then the best for last is going to be technology and communication services. So without further ado, let's get started. You want to get this party started? I say, let's do it. Nike is number 1. Just do it. Been around for obviously a long time. Been a great performer for a long time. I played college football and I had to wear the exact same pair of Nike cleats my entire career. I was somewhat superstitious. I don't know why I'm not superstitious when it comes to the stock market, but I actually had this exact pair of Nike cleats that I started as a freshman, and after that season, I went and bought the same pair of cleats. I bought 4 or 5 pairs because I was worried they wouldn't make them anymore, and I was superstitious. They felt good. I played really well. I had a great season, blah, 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 but I was superstitious and wanted those exact same Nike cleats. And I know there's a lot of athletes that are like that like a certain brand or even sometimes a certain sneaker. Now you look at nowadays, LeBron and whoever your favorite player is, Curry. I mean, they literally will change shoes at halftime and they wear a different pair of shoes every single game, even a completely different design, but they're also paid big bucks generally to do that. I want to do something a little different on this and show you my actual position. So I bought Nike several years ago, and my wife and I decided to buy Nike when the NFL announced their partnership. We're big NFL fans. We do a lot of fantasy football. Been watching, NFL for 20 years. I've had Sunday Ticket for 20 years. So anyway, I digress. But here's our Nike shares. You can see I own 87.9 986 shares. Of course, you get fractional shares because dividend being reinvest. Right now, it's worth about a little under $9,000, and it shows the unrealized gain of 277%. That's not always 100% accurate, though, obviously, because that's showing the realized gain off of the share buy price. And when the dividends are reinvest, it's counting that, as part of your purchase price. But a lot of those, all of those are free, free dividends, free shares. And so, the actual number, if you look at your cost basis, is going to be higher than that 277%. But nonetheless, 277% is still really good. You can see first acquired them back in 2012, August of 2012. And so you can see, these are at 300% gains. And then we've dripped all of our dividends. You can see, this pretty long list goes all the way and shows you every single dividend. And we have a total cost basis that's showing of $2,379. You can see these are just fractional dividends because Nike doesn't pay a huge dividend percentage. But let's go take a look at Nike and go into the Fidelity quote. Let's go to research. So here's the screen I've been showing you within. This is Fidelity in case you're new to the channel or if you haven't seen any of our videos on this series yet. The dividend yield is less than 1%. The P/E ratio is around 36. Obviously, right now we're down because there's more China coronavirus worries. So there's stocks like Apple and Nike getting hit. But this thing, look at the chart on this. Here's a 10-year chart. And they have been increasing their dividends at a healthy clip. And you'll see that. So at the very end, I'm going to give you 10 picks right now. And at the very end, I'm going to compare those 10 picks and show you the difference between, which one has a better performance over a 10-year analyze, which one has more dividend growth over 5 years, which one has the higher dividend yield, all those things. So you can see the earnings they beat. The last two, they had a miss here for 4-cent miss, but then a 16 and a 12-cent beat. The dividend payout is 25. It's a 25-cent dividend, which is a little bit less than a half, or not half, but 1% dividend yield. All the technical analysis looks pretty strong. It looks like it's a little bit overbought right now on the relative strength index, the RSI. It might be, it's kind of, it's a 43 in the valuation. It might be a little bit frothy, but take a look at Nike. It's one that I've owned, obviously, for several years. I don't plan on selling anytime soon. I wish I would have bought more back in 2012, but it's always, woulda, coulda, shoulda. You look at it that way, right? It's one of my rules, but Nike's a great one. Stock ticker NKE. All right, so we just covered a consumer discretionary stock. Let's jump into a consumer staples stock. And the second one on the list is going to be Church & Dwight. That's stock ticker CHD. And of course, this has been around for a long time. There's a lot of products that Church & Dwight own that you might not realize are CHD products. But before I jump into that, let's just look quickly at the yield. And I do want to point out that this one is one of the top performers. You think of, consumer product, consumer staple type goods, and you think of a Clorox. You think, well, that's a good one. And Clorox has done okay, but when you actually look at the numbers, you look at the dividend growth, you look at the performance over 10 years, a stock like Church & Dwight has absolutely crushed Clorox. And I would buy a Church & Dwight right here before I would buy a Clorox, me personally. Now, the coronavirus, that's a whole different story. That might give you a little bit of a short-term edge with Clorox because obviously bleach is one of the things that will kill, one of the only things that are going to kill viruses. So there is a potential play there. But when I'm talking about holding something for 10 years, Church & Dwight has actually performed very well, and it's performed better than something like a Clorox. So I wanted to include this one. It was a pretty exciting one. It's one of those stocks where it's right under your nose, but you don't really think about it very much. At least I never had until I started doing some research. So, the valuation in all these numbers look pretty strong overall. The growth stability is kind of in the middle. But it pays about a 1.26% dividend yield, which isn't very high, but I'll show you at the end. So again, I'm going to show it, give you the 10 picks at the end. I'm going to compare. This has one of the lower dividend yields, but it has one of the highest dividend growth rates, and it has performed pretty well. You can see on the 52-week, it's performed at about 19% right here. But over a 10-year run rate, it's actually outperformed the S&P 500 and done quite well. And stocks like this will also do very well. Typically will do very well when the economy has any kind of downturn or anything like that. So when you think of, a bear market or what have you, it's one of those companies that's going to perform fairly well. So here's their website, and I wanted to kind of go through some of the brands because I think this is really important. And there's a lot of brands, like I mentioned earlier, that they own that you might not realize. So obviously, Arm & Hammer is the one that stands out for most people, and they also have things like OxyClean and Extra. And so first response, so that's pregnancy testing. They also have a line, Trojan, condoms. And they have a bunch of different, so Little Critters. I thought that was dog food, but it's actually vitamins. So there's a whole line of vitamins and everything here. There's the Arm & Hammer. There's several different lines. There's the Feline Pine, which is odor control, feline pine clumping litter, of course, for litter boxes if you have cats. There's Kaboom. There's Orange Glow. They have different scrubs and cleaners. They've got Water Pick, which you probably have seen. Maybe your parents, maybe you have one, maybe somebody you know. It's one of those kind of devices that will spray water in between your teeth, kind of like a flosser, but it's much more effective. So they actually own Water Pick, which I didn't know. Orajel. So if you have a sore tooth, you put that on there. It's that little bottle, little cream of Orajel, and then Nair hair remover. I tried doing that once actually in college before Cancun. Tried to get my chest, get rid of all my chest hair. That was an epic fail. It didn't work very well at all. So maybe it works okay for you, and I have sensitive skin. But anyway, Nair hair remover, that's not my thing. I tried it once 20 years ago, and it didn't go so well. I wanted to just go through this press release. This is from January 31st, so it's only a couple weeks old. And I thought this was really good. So when you think of a company like this, right, this is a very kind of boring consumer product type company, consumer staple company. You think of sales growth, it's usually not going to be very, very fast growth. But, you see things like sales growth of 6.5%, domestic 6.3%, and international 10%. That's actually an exciting number for a company like this. It really is. Organic sales of 4.4%, of that domestic being 3.5%, and international 10.6%. This is what I'm looking for when I'm looking for kind of one of those boring consumer staple type companies. I want something that, has dividend growth, that they're showing dividend growth, that they're continuing to innovate in products, and that they're having, you're having an increase in sales growth and organic sales, especially international, because there's a huge play. Obviously, most homes in America have certain, products and brands that they use, and it's a staple, and they kind of go back to it. And you can persuade percentages of market share, but the international growth can be really big. And so speaking of that, I wanted to also show you innovation. So one thing I like about Church & Dwight is that they spend a lot of money on R&D. So for them, one of their goals is to really focus on R&D and marketing as well, to identify consumer needs and develop new solutions that meet those needs. So 40% of consumer product sales are actually from new innovation products. And that's really important. So you'll see things like Arm & Hammer baking soda integrated into toothpaste. You'll see, they've got, different, like Kaboom with OxyClean. So they have a Kaboom product, they have OxyClean, and they mix the two together and try to do different things, make it colorful and exciting with marketing. I think they do a really good job of that. And they've continued to spend money to grow that and to try to get new products. So going back to the full year results, we talked about the growth. The earnings per share growth was only 1.8%, which I'd like to see maybe a little bit higher. The gross margin was up 170 to 45.8%, which is pretty good. And then that was for fourth quarter. So the full year 2019, they had sales growth of 5.1%, organic of 4.4%. But what I liked about that is it seemed like at the end of the year they were going into a trending upwards. You know what I mean? So the fourth quarter seemed really strong in the international, and it seems like there might be something there. Maybe the stock, has some room to run here in the short to midterm. It might be a good time to get in possibly. So the fourth quarter review, I wanted to go through the specialty product net sales, operating cash flow. Here, dividend increase was 5.5% dividend increase. The company's board of directors declared a 5.5% increase in the regular quarterly dividend from basically 22 cents to 24 cents a share, equivalent to an annual dividend of 96 cents per share on an annual basis. This raises the annual dividend payout from $224 million to approximately $237 million. The quarterly dividend will be payable March 2nd, 2020 to stockholders of record on the close of business of February 14th, 2020. So unfortunately, you've missed that for this next dividend, but of course you can get in for the rest of the year. It also talked about 2020 new products. Hopefully you can read this. I'll zoom in a little more. Mr. Farrell commented, innovation continues to be a big driver of our success. In support of our long-term strategy to drive revenue and earnings growth, we are pleased to announce 2020 new product launches in several categories. In the household products portfolio, we're launching what we believe to be significant innovation, introducing Arm & Hammer laundry detergent called Clean and Simple, which has only 6 ingredients plus water. Of course, guys, this is a huge trend. People are trying to be healthier. They're trying to be safer for the environment. They're trying to, to be sustainable. And this is really good to see the company moving towards that direction. And, obviously it helps them make more money, more revenue, but it also is good for, for the environment as well. So it has 6 ingredients plus water. It is on trend with the consumer's desire for better for me products, which are simple, efficient, and have fewer ingredients. Arm & Hammer Clean and Simple has 6 ingredients compared to 15 to 30 ingredients for typical liquid detergent with no compromise. I'm saying it's just as good. It works just as well. In the personal care portfolio, they're also launching a line of waterless cleansing foam for curly hair. They also have Trojan and G-Spot condom. Flawless launches new razor, and then Water Pick, water for wellness shower heads, blah, blah, blah. There's lots of stuff in there, but it's good. It's good that to even see the leadership talk about new products. A lot of times you go to, Procter & Gamble or something and you look at some of their earnings. They're not always necessarily focused on that. And these guys really seem to be focused on innovation. Me being, kind of a tech guy, technology guy, I always want to see companies that are trying to, even though this isn't technology, they're still trying to innovate and be creative. And I do like that a lot. So take a look at this one. I think it's a great one for the consumer staples, and you'll see at the end of the 10 picks how good it really has performed over the last 10 years. The stock ticker on this one for Church & Dwight is CHD. Next, we have DPZ. And before I go into Domino's, I do want to explain the 10 picks on here really have great diversity across different segments within the different sectors. So, we covered Nike, which obviously footwear. We covered some consumer staples with Church & Dwight. And now with Domino's, we're kind of into the fast serve restaurant. And I like these guys because they've performed really well, but also they're always developing new technology. They were one of the first that created an online tracker app to kind of track where your pizza's at and what process it is in the delivery. And everybody has one now. So even if you go and order from Papa John's, you have a tracker as well. But Domino's, this was several years ago. I was getting my master's degree. I want to say it was probably 10 years ago when they first introduced that tracker and they had a mobile app and everything. And one thing they've been really pushing is autonomous vehicles to actually have cars that will be able to drive the pizza to you with no, obviously no driver, which would save them a ton of money and help profitability in the long term. So I do like this one. If you haven't figured me out, I do like technology. So I try to invest in technology, even if, this is a restaurant, but it still, tries to innovate itself through technology. And I do find that interesting. And I think there's value to that. So real quick, just looking at this, so the technicals say that it's in a bullish continuation chart pattern. So according to the technicals, we like to look at this once in a while. This isn't always right. Again, I've said this a million times, but right now it's trading at 295. And this is saying that, basically with this continuation diamond bullish pattern, that it could go up to $359 to $376 over 429 days. So this is saying you could buy the stock right now at 295, and that in a little over a year, it could be worth 376. It is showing you that the stock price is the trajectory is upward, which is what you want. I think that this company will do well over the long term. If you're holding this long term, there's always going to be a need for pizza. I personally don't love Domino's pizza, but it doesn't matter what I like. It matters if the company is profitable or not. I don't own Domino's for that reason, but I don't own any pizza stocks. If I were going to buy a pizza stock, it would be this one. And I do think that this is one of the better picks on the list because it is continuing to grow their dividend. They've performed very well. I actually wanted to show you this chart. Here's 2006 to present, and it's, like a lot of stocks. It's gone through a little bit of, issues. They changed CEOs and things like that. The last CEO just did a dynamite job and really took this company to the next level. Hey guys, I want to give you a quick update on Domino's because I made this video before it shot up 25% yesterday. On the 20th of February, Domino's, you can see here, shot up 25.6%. Now they've raised their price targets here. You see a $410 price target. Goldman Sachs raised to $400. They had really strong earnings. They also announced some expansion internationally. I believe Portugal is one of the spots that they're going to be moving into. So some exciting news for Domino's, and unfortunately a little bit late to the party here, but I still think there might be some room. According, again, to a couple of these analysts, it looks like it's a $400 to $410 range stock. So if it dips a little bit, definitely could be something to keep an eye on. But I wanted to provide this update because a 25% move for a stock like this that's been around a long time, that's it's basically a fast food place for pizza. It's a pretty significant move. I was saying yesterday to some of the guys, I can't think of another stock that's, moved 25% that's in a, consumer discretionary, food type of industry like that. It doesn't happen very often. I'm sure it's happened before, but very rarely. So anyway, just wanted to give you this quick update on Domino's Pizza. The 25% jump yesterday. It's down a little bit red pre-market right now. In terms of the business model and the performance, the management, all the things about the actual business, I like the business. I don't necessarily love the pizza. I mean, we do it occasionally, like with our daughter's birthday party. We needed, a bunch of pizza for a bunch of people, and we did Domino's because they are very inexpensive. You can see $5.99 mix and match deal. So this is really cheap pizza. It's going to be something that, of course, if you have a bear market, this isn't going to go anywhere. People are always going to buy pizza. Here's that tracker I was talking about. There's actually a patent on it, U.S. patent number right here. Let me zoom in. And you can go in and track through your phone number. But if I had a pizza ordered, it would show me, the process through the whole thing. This has been around for a long time. In fact, when my wife and I were getting our master's degrees, we had a same class together, and it was a marketing class. And we did a pretty big paper on Domino's business model. And we actually tested the tracker. And this was 10 years ago when it was brand new technology. And the tracker said that the pizza was going to be there in 15 minutes, and it was over an hour late. So that was another reason I never bought the stock. But, it's one of those things where you have a sample size. We were that one bad stat for the day out of 1,000 orders. It just happened to be our unlucky day. And it just, you can't always judge off of one thing, but unfortunately sometimes people do. And it did influence my decision not to buy the stock, which, I would have actually done well if I would have bought the stock. But anyway, take a look at this one, the third one on the list, Domino's Pizza, stock ticker DPZ. I also have some additional coverage on this. I'll put a card up on your screen. And if you want to take a look at that one, it actually has a handful of different fast food restaurants in there. It's a fun video. It's actually a really good video. There's a lot of information on it. It's called the top picks for stoner foods. So basically, like playing off the legalized marijuana. So you've got things in there like Yum Brands and Domino's Pizza, basically saying that as marijuana legalization continues to occur, that stocks like Domino's will benefit from that. And you think it's funny, like, yeah, right. But if you're bored, go Google Peyton Manning, Denver plus Papa John's. And he opened a bunch of Papa John's several years ago when Colorado first announced legalization, and he made a whole lot of money on them. He ended up selling them, and had to do with some of the NFL rights. Papa John's lost their rights to the NFL, I think, to Pizza Hut, and then because of that, he had to sell. But he did really well. I can't remember the profit on it, but it was very, very profitable. He had multiple stores in the Colorado area. Of course, he played for the Denver Broncos. So kind of getting off topic a little bit there, but there is another video to take a look at. It has more information, and there are some really good stocks, within the fast food sector that you can take a look at as well. Number 4, and I mentioned earlier that these 10 picks do have a lot of diversity, and we're going to continue the diversity and go from pizza to hotels within the consumer discretionary sector. And this one is, of course, a large cap, $47 billion. It pays about a 1.3% dividend yield. It's performed okay, just 22% in the last 52 weeks, but over a 10-year annualized return, it's done pretty well. And the dividend growth rate on it is pretty good. It could be better, but it's actually one of the middle of the road to above average out of the 10. I do like the brand a lot. I do travel a lot for work, and I typically try to stay at a Marriott property. They actually own a lot of different properties now. Here's their different brands. So like I love Ritz-Carlton and St. Regis. Obviously, they're expensive, but they got some high-end brands. But they have Courtyard Marriott, which is still very nice, but it's a lot different, of course, than the Ritz-Carlton, the regular Marriott, the Sheraton. They've made some acquisitions, so there's a lot of with the whole Residence Inn, Spring Hill Suites, Fairfield. I mean, you've heard of all these before. Le Méridien, W Hotels, JW Marriott, the Luxury Collection. There's some really nice properties within this list. They call it Bonvoy, which I don't really love that name, but that's what they call their rewards plan that basically covers your rewards membership across all these different brands. But take a look at Marriott. It is one that I own a very small position on this. It can be one of those stocks that are a little bit fickle with news and even with the economy. If you go into a recession, people are going to travel less. There's going to be budget, holds for work. People are going to be spending less money. So this is, one that does have some fluctuation, a little bit cyclical probably with the market. But I do think if you're going to buy something and hold it long term, I think you could do a lot worse than a Marriott. I think if you're looking for something in that sector, within, real estate or, hotels, this is going to be one of the top picks. And I think the dividend growth rate is attractive where they're going to, constantly grow that. And if you're holding it for 10 years, I think you'll be in a good position with the stock. Stock ticker is MAR. Number 5 on the list, and just got announced today, or at least this is the USA Today from today, February 18, 2020. Warren Buffett buys $500 million stake in Kroger, which is our 5th stock pick. So Berkshire Hathaway acquired 2.3% stake in Cincinnati-based Kroger. Government disclosures say word of the legendary investor's $500 million purchase in the nation's second largest grocer said the company's stock soaring in aftermarket trading last Friday. So it actually happened last Friday, but it was aftermarket. Most people aren't trading aftermarket, so today would have been most people's first opportunity to buy Kroger. Now, of course, today it's up 5.8%. It was up way higher than that. You can see on the chart here, it actually was quite a bit higher at one point, I think over 10%, but it's still up 5.8%, which is pretty unusual for a grocery store. And one of the few things that are going to make a stock like Kroger jump 6% in a day are going to be earnings that blow it out of the water, or Buffett saying that he either is going to buy or showing that he bought, shares in the company. 2.3% is what he owns of it. And, everybody wants a piece of that. It's, it seems like that's kind of the trend. So 2.27% dividend yield. So it is a nice dividend yield. The PE ratio is a 14.4. The 52-week price performance actually is negative 2.5%, which I thought was interesting. I'd never really done any research on this. According to, everything that I see here, that it's somewhat undervalued. I mean, it's not going to have much growth really because it's a grocery store. The margins it's not a high margin business really. But, it's probably why Buffett bought it. He loves buying value, in banks and airlines, things like that. But with that said, he bought, he was involved with Kraft Heinz and that didn't work out either. So I'm not bashing by any means. I'm just saying, just because Buffett bought Kroger, just, don't go buy Kroger just because he did. That's all I'm saying. So let's look into it a little bit more and see what's going on. Obviously it's a grocery store, so it's not really that sexy. I thought it was kind of interesting. The first thing you see is plant-based diet, and it's got Beyond Meat and $5.99. It's hard to believe that people pay that much because it's 4 times more expensive than beef. But it's each his own. And I actually own Beyond Meat stock. I believe it's a trend that will continue to grow. We talked about earlier about wellness and doing good for the environment. Now, Beyond Meat, a lot of people will say, well, it's not any healthier and stuff like that. I think a lot of the people that are into Beyond Meat, a lot of them like it because it's reducing the amount of CO2 from cows and things like that. So a lot of the people that I've talked to about Beyond Meat, it's more about the environment impact than it is necessarily that it's healthier. Because there's a lot of salt in it. It's if you compare it, it's not. There's a lot of stuff in it that some people say, well, why do I want to eat that? It's more, for a lot of people, it's more of a play on sustainability for the planet, less animals, things like that. So anyway, that can get political like almost anything can. But take a look at this one. I don't want to spend a lot of time on it because, I looked at the financials and, it's pretty straightforward. Like I said, there's not a lot of growth to it. It's not going to be a home run type stock for you. But if you're looking for a somewhat boring, somewhat safe, maybe a value play with a decent dividend, this could be for you. Stock ticker is KR. All right, number 6 is a 2-for-1, and it's Home Depot and Lowe's together. And the reason for it is if you look at the stats at the end of the 10 picks, you'll see they're very, very close. Home Depot has a little bit higher dividend yield. It also has a little bit higher dividend growth, but it does have a higher payout ratio. It's right at that 50. In fact, it's a little over 50%, and Lowe's is more like 40%. So you could argue, a lot of people could argue that Lowe's is more of a turnaround story. It has more upside potential. Home Depot is up 31%, 30.54% over 52-week, which I think is pretty impressive for a consumer discretionary type stock for home improvement. But honestly, some people like Lowe's, some people like Home Depot. It seems like a lot of things. Some people like Coke, some people like Pepsi. Honestly, from a business perspective, they're very similar. They're very, very similar. Even the stats are very similar, other than slight differences on the yield and performance, but they're still very, very close. Obviously, these guys are based out of Atlanta, Georgia, founded in 1978. If you would have bought like $1,000 in stock in 1978, it'd be worth $1 million a day. Random, useless information. But it's a good company. I prefer to go to Home Depot. When I lived in Minneapolis, we had a Home Depot, close by, and I would go to it all the time. Where I'm at now, there is a Home Depot, but it's farther away, so I end up actually going to Menards a lot of times. But we do have a Lowe's and a Home Depot, and Menards, we have multiple locations. So anyway, Home Depot, you can see. I mean, here's Home Depot's website. Here's Lowe's, right? You see, it's pretty much going to have the same stuff, guys. It's not rocket science. Kitchen cabinets, all the way toilets, kitchen faucets. You go in here, kind of the same stuff. I mean, they both have, do-it-yourself project ideas and videos and classes. Both will have installation services, so they'll actually install the carpet if you buy the carpet from them. They're very, very similar business models. When you get to the back end on technology, there are some differences. Both have been improving in that area. I actually prefer the leadership of Home Depot. I prefer the marketing, the orange colors, maybe because it matches Fired Up Wealth. That's probably why. But I just, I've been in several Lowe's, and I don't know why. I've always liked Home Depot better. And you can ask 10 people, and 5 will say Lowe's and 5 will say Home Depot. But take a look at either one of those. I would say you could buy a little bit of both, or you could pick the one that you prefer. If you're a Home Depot person, maybe you buy some Home Depot. If you're a Lowe's person, maybe buy some Lowe's. But dig into it a little bit more. It is pretty expensive here. I mean, it's a 24 PE ratio, so it's not outrageous. But for a consumer discretionary home improvement type of a stock, that is somewhat of a high PE ratio. The PEG ratio is close to 3. But take a look at both Home Depot and Lowe's. So Home Depot, the stock ticker is HD, and then for Lowe's, it is LOW. Up next, we have Hormel Foods, stock ticker HRL. And hear me out on this one, because it might sound boring, it might not sound exciting, but actually, this stock is pretty amazing. The 52-week performance you can see is only 12.85%, but if you look at a 10-year annualized return, it's done pretty well, and it's actually grown its dividend very attractively and pays just under a 2% dividend yield. Surprisingly, it's a 27 PE ratio, and a lot of these are kind of elevated at this point with the market, but there's a Seeking Alpha article. Now, I own Tyson and I don't own Hormel, and I do think Tyson is a good long-term hold for a DGI with growth, the DGIF type stock. You can see this article is from August of 2019, and this is a Seeking Alpha article. And 3 months ago, I analyzed Hormel Foods and Tyson Foods. I was already an investor in Tyson and increased my position. However, on 9th of August, against my expectations, Tyson failed to grow its dividend. This has forced me to look again, and he's moving out of Tyson into Hormel. I have not done that, but I will say this. Tyson, I wanted to be on this top 10 list very badly, but because it didn't grow its dividend, it technically kind of falls off the metric a little bit, and I could have made an exception, but after doing my due diligence, I actually think Hormel is probably a better choice at this point. If I were to buy if I were to buy a stock here between Tyson or Hormel, I think Hormel is probably what I would buy. With that said, if you were to ask me which one do you think would perform better over 10 years, I might say Tyson. And so you say, well, that just contradicted. It kind of did. So make your own decision. But here's the thing. They own Spam, which, some people love Spam. I've got a lot of friends from Hawaii that, if you go to Hawaii, I don't know if you've been there before, you go to McDonald's and a lot of fast food joints, you can get like Spam on your McMuffin, and so instead of a sausage, egg, and cheese McMuffin at McDonald's, you can get a Spam one. And there's tons of restaurants that have Spam. I thought this was a really cool kind of snapshot to give you. So Applegate, you might have seen like healthy kind of, sausages, like maybe chicken, apple, bacon sausage, they have organic kind of stuff that I've seen. They've got the Awesome Blues barbecue, which depending on where you live, you may or may not know what that is. But pretty much everybody probably has Hormel bacon in the grocery store. They also have the Hormel chili, which is pretty popular. They've got the Columbus. So if you go into a deli, you go into your grocery store at the deli, a lot of the big deli chain, big grocery stores with delis will cover, they'll carry Columbus. They also have quite a few things down here. I mean, check this out. So they've got Happy Little Plants. They've got Hormel Gatherings. They've got Fuse Burger. So they're really getting into the meatless options and the vegetable type options to compete with Beyond Meat. And that's one of the reasons that these guys have actually done pretty well. You can see Happy Little Plants, numerous retailers operate interest based on taste, versatility. This says it has, its flagship product is a ground plant-based meat alternative that is all natural with 20 grams of non-genetically engineered, non-GMO soy protein, only 180 calories, no preservatives, cholesterol. I don't know if you've seen Happy Little Plants, but they've got Hormel Health Labs. They're doing different juices here. They've got Jennie-O, so you've seen like the ground turkey products and Jennie-O turkeys that you might even get for, Thanksgiving. I mean, look at all this stuff. There's, Stag Chili. There's a Spam that we talked about. Skippy Peanut Butter. That was one I didn't realize they owned. Lloyd's Barbecue. So you'll see those tubs of different, Lloyd's, pulled pork and things like that at Costco and maybe at the grocery store. So anyway, they've got some really good brands. Obviously, dig into more and look at some financials and look at the management and things like that. But this Vital Cuisine, I wanted to take a look at. They have more than just this Happy Little Plants. They've got a couple of different things that are focused on plant-based meats. So I think a lot of people are like, hey, if I can, get a 2% dividend yield and it's kind of a safety stock, this one's not going to go out of business. It's got the scale. It's got the, they're in nationwide distribution network. A lot of people will say, well, I want to get in on this plant-based meat thing, but I want to buy something like a Hormel. Tyson, all of them are trying to do different things in that space, but Conagra Foods even has their own line. So, Conagra Foods, though, I looked at that one because I own a little bit of Conagra Foods, which actually had earnings today and it was bad and it's down like 8%. I'm still green on it, but I probably should pivot out of Conagra Foods and go into like a Hormel. The numbers on Conagra Foods really aren't very good. Hormel looks a lot better, but it is expensive here. I mean, I wish that I could have bought this one back. It was a $40 stock back in November and it's ran up $7. So pretty nice, nice little run it's making here. But anyway, take a look at Hormel. Stock ticker is HRL. All right, time for another 2-for-1. And now we're going to do TGX and ROST. And it's kind of like Home Depot and Lowe's where you might have a favorite and it could be a regional thing. Some people prefer ROST over TGX. I personally prefer TGX, so that is my actual pick. But I'm also going to talk about ROST here, and that could be a substitute for TJX, or you could even buy a little bit of both. But TGX has a 1.5%, just under a 1.5% dividend yield. It's got a 24 P ratio. It's performed at about a 28%, 52-week return. It looks like it's pretty attractive in terms of the fundamental analysis. The technicals look, fairly strong at the moment. Let's go look at ROST stores. ROST stores is going to have, dress for less. It's very similar. Again, like Home Depot and Lowe's, there are some differences between the companies, but they're very, very similar. And so it did not make any sense to include, four picks between, those four companies. I decided to make it two and talk about each. So you're really getting 12 picks in the top 10, and you can decide, which are, best for you depending on what you might like, or maybe even, like I said, buy a little bit of both. But I like TJ Maxx because, in the Minneapolis type area where I'm located, they have a lot of Marshalls and Home Goods, and you see those more often. So if you're in the South, maybe if you're in North Carolina or something, you might see more ROST stores. And, I don't know because, I'm not usually, I travel a lot for work. When I'm traveling, I'm not going out and buying stuff at ROST stores, right? But I can tell you that where I'm located geographically, you see more of the Home Goods and the Marshalls. Downtown Minneapolis has a Marshalls, and you'll go there to buy, it's basically treasure hunters is what they call it. So there's several articles out there, and, it'll tell you about Amazon and how TJ Maxx and ROST are basically, they're resilient to Amazon because the people that are going to buy at a Home Goods or a Marshalls, they want to go and buy something, but they might not necessarily know what they want to buy. They just, hey, I need a new shirt, but I don't know what it is, and I don't want to spend a lot. You go and look, and they've got all these different shirts and say, okay, this one looks good. That's hard to do on Amazon. So it's kind of a unique experience. It's a unique customer because these type of stocks will typically still do well in a bear market because you're going to have more people, that are going to spend less money. They're going to want to spend less money, and they're going to value shop. And even when the economy is good, there's always going to be people that shop at places like this. My wife and I make good money, and we like shopping places like this because we like getting deals, and more and more people are money conscious, and especially people that are watching this video. If you're into the FIRE movement, if you're into DGI investing, you probably are just like me where, you like to save money, you like to get a good deal. And sometimes you like to go in and say, hey, I want to buy, something for my house. So like this thing here is from Home Goods, right? And it looks pretty fancy, and it was not that expensive. If you go and buy that same thing from a high-end department store, it's going to be $150 or something stupid. Get a Cartier one, and it could be hundreds of dollars. Where you go buy that, and I've got stuff throughout my house that it's inexpensive but looks nice, and I get it at places like Home Goods. So call me cheap, call me whatever. I'm frugal. I'm trying to save money and retire early. So I like places like this. I don't own either of these stocks. If I were to buy one, it would be TGX. It's one that I probably should have bought a long time ago, and it's on my shopping list. The problem that I have is I research so many stocks, and there's so many good ones that it's just hard to own them all. I've already got way more positions than I probably should have. But take a look at both TJX and ROST. The stock ticker on TJ Maxx is TJX, and for ROST, the stock ticker is ROST. All right, guys, the 10th one on the list is a home builder. It's Lennar Corporation, which I've never really done a lot of work digging into home builders. I've never owned home builders. Obviously, they've done pretty well in this environment. You can see that this particular builder is up 45.83% over 52-week. It's the lowest dividend yield of the 10. It's at 0.71, but it does have decent growth. And of course, the overall performance and growth of the actual dollar, if you were to buy the stock, has been pretty impressive. And the PE ratio on it is only at 12.2. So it was another one where I tried to find a million things of why I shouldn't include this one, but I simply couldn't. It just fits the model too well. The only thing I could say is, obviously if we have a downturn in the economy, you're going to have, possibly a dip in the housing sector. But when you actually dig into what this company focuses on, they really do some inexpensive home building. And so I think that this is one that, I'm not saying it's bulletproof to a bear. It's not. But when you look at like luxury home builder, they're going to get slaughtered compared to a Lennar. So Lennar Corporation with its subsidiaries is a home builder primary under the Lennar brand. It operates Home Building East, Home Building Central, Home Building Texas, Home Building West. They also have financial services and a couple other things. Includes the construction and sale of single-family attached and detached, as well as the purchase, development, and sale of residential land. It sells primarily single-family attached and detached homes and communities targeted for first-time home buyers. And I think that's really important. So if you look at their website, I went in there and I typed in Houston because I knew They build homes in Houston. They build all over the place though. But this is in Houston. Here's a 18119 Shimmer Lane, and its price says 287 to 355. They've got some more expensive houses here, 540 to 713. Here's one that's 254. But you're thinking Houston. I mean, 199K here. I mean, I don't know the Houston real estate market like an expert. I did sell real estate for 10 years, but that was in the Minneapolis market. But I would be willing to bet that you're not going to get a whole lot cheaper than $199,000 for new construction in the Houston area. And I'm sure that that's not very close to Houston. I'm sure it's a third tier type suburb. But, you can go in here. It's kind of a cool deal. You can look at the different floor plans. So you can actually search by floor plans that way. They've been around since 1954, which I think surprised me maybe a little bit. The leadership team, pretty impressive overall. I kind of just spent a little time looking into this. I mean, I have a real estate background before technology, and I would say that, based on my limited knowledge in these, mega builders, that Lennar looks like a pretty attractive one that has, pretty good leadership. Here's the CEO. Let me zoom in here. So he joined Lennar in March 2006. So he's been there a while, which, I like to see. Serves as the board of directors of Eagle Materials as well. I don't know if you've heard of that, but that's New York Stock Exchange. Ticker is EXP. He's also on the board of directors of 5 Point Holdings, FPH, and that's the largest developer of master planned communities in coastal California. He hasn't been involved in the home building and the construction industry for more than 30 years, from 1993 to 2003. He was the board of directors of D.R. Horton, DHI. So that's another home builder. It did not fit our growth model. And I personally wouldn't buy D.R. Horton just based on some personal experiences. But take a look at Lennar. It might not be your cup of tea. You might not want to invest in a large cap home builder, but if you if you're looking in the home building space, this is the best one in my opinion. There's obviously risks with the economy. If the economy turns and home building starts going, but if the economy is strong and the interest rates continue to be low, you can bet that there'll probably still be home building. And a lot of areas that you look at, like where I live now, they can't keep up the demand. I mean, there's way more people wanting new homes than the builders can build quick enough. So they're building right now across the street. They're building over here, over there. There's 50 houses just in my area, going up, and they're all fairly expensive houses too. So, it's not something that I personally am invested in, but it does fit the model. I wanted to give a good variety of consumer discretionary and consumer staples. So I think these 10 picks did that. Stay tuned. I'm going to compare these 10 and show you the differences, which one has the best growth, which one has the best, dividend growth, things like that. And then at the very end, I'm going to give you some bonus picks, and there's quite a few bonus picks, so stay tuned. All right, so as I promised, here is the recap of the 10 picks. And of course, there's going to be more than 10 because we did Home Depot and Lowe's as one pick, and we did ROST stores and TGX as one pick. So you're going to have 12, and then I also have Tyson in here. So there's a total of 13 picks in front of you. The reason I include Tyson is it's one of my favorite picks for consumer staples. The problem is that they didn't increase their dividend this last August, and therefore it was disqualified based on kind of the rules of the game. And I have made some exceptions along the way, but that one is pretty critical, so I decided to make it a bonus pick. With that said, I do have a decent-sized position in Tyson, and it's something that I think you should at least consider when you're looking at Hormel. So a lot of these have, one or the other type of a thing, like we mentioned with Lowe's and Home Depot. So let's look at so first of all, the 10-year annualized return. So the total return over a 10-year annualized, you can see Domino's Pizza has crushed it, 40%, which is insane. Because of that, it's almost scary to me. Like, is it going to be able to, keep that kind of pace? And it has been beaten up a little bit. So, maybe it rebounds and starts coming. If you look at the PE ratio, it's not crazy expensive. So hard to say. Dividend payout ratio is 31%. Which actually is high considering the dividend yield is only a 0.89%. Again, I'm talking about Domino's. But it also has a pretty attractive 21% dividend growth rate for a 5-year average, which is pretty good. The second best performer over the 10-year annualized return is Lennar, which is one of the reasons I had to include it. You'll notice a trend here that the lowest dividend yields have the highest returns. And that's why it's so important to not just be laser focused on, oh, this pays me a 3% dividend yield. That's great. Well, it's great if it pays a 3% dividend yield, but if it's only, in Kroger's case down here at the bottom, yes, it pays a 2.27% dividend yield, which is just slightly higher maybe than the S&P 500, but it's only giving you a return of 12%. So you can argue, well, 12%, this actually has underperformed the S&P 500. That's correct. The reason that Kroger is in there is because they recently had a big buy from Warren Buffett. And so, that kind of helped that decision. Did I buy solely off of Warren Buffett? No. But if you look at it, it's got an attractive yield. It's actually the highest yield on this entire list at 2.27%. It still only has a 50% dividend payout ratio. The 12% isn't a great 10-year annualized return, but it's not terrible. And then it did have a 11.58% 5-year dividend growth. So it was over the minimum of at least 10%. You will notice that Church & Dwight actually only has a 7.46% 5-year dividend growth. And so you say, well, why is that one in there? Because it didn't meet the qualifications of 10%. I did make an exception on it. The reason I made the exception on it is it has performed at an 18.72% 10-year annualized return. It has a dividend payout ratio that's only 38%. And I like the growth potential opportunities, for the company just based on digging into it a little bit deeper in my research. So that's why that one's on the list. If you look at, we'll just go real quick here. Dividend yield, we already mentioned Kroger is the highest. So that has a 2.27, then Home Depot about 2.22, Tyson a little over 2%. I like Tyson because even though it didn't increase its dividend this last August, it still has a 33% 5-year growth rate, which is part of the reason I think they didn't increase it. That is actually the highest on here. And so they might have said, hey, we've been increasing our dividend. We're going to not increase it this time, and we're going to invest in the company for growth. I don't have any problem with that, which is why I make an exception and buy it. And it's why I'm including it here. So really it's like an 11th pick, even though it's technically a bonus pick. You can see the growth. So Lennar second, Home Depot. Home Depot is one of those, this is the home run hitter, I think, out of the group. The only thing that it's a little bit off on is the dividend payout ratio is, it is above 50%, slightly at the 53.67, but it's, 26.74% 10-year annualized return. It has, 23% 5-year dividend growth rate, just really great numbers across the board. And you can see with like the ROST. So let's compare Home Depot and Lowe's. Home Depot has a 2.22% dividend yield. Lowe's has a 1.75% dividend yield. The Home Depot 5-year dividend growth rate is 23.68 versus only a 19.05 for Lowe's. The payout ratio is higher at 53.67. Lowe's is only at 41%. And then the 10-year annualized return, Home Depot is outperforming Lowe's by about 5%. Home Depot's is 26.74. Lowe's is 21.12. So I prefer Home Depot. I also prefer the numbers if I'm looking at it here. Like I said earlier, some people might say, well, Lowe's is more of a turnaround, comeback kind of a story and has more upside. That could be true. You do what's best for you. And then the other one we wanted to compare is ROST stores right here with TJX, and they're kind of next to each other. So TGX is paying the 1.45% yield versus only 0.84% yield with ROST. The dividend growth rate is almost the same, 21 and 20. Dividend payout ratio, you've got a little bit higher on TJ, which makes sense because they're quite a bit higher dividend. And then the annualized return, now ROST is actually beating TJX with a 28% versus a 22.65%. So very interesting stats. You might want ROST because it has a little bit more total growth and less yield, or you might say, hey, I want a little bit higher yield and a little bit, less growth. But at the end of the day, it's going to be about future performance. Just because it performed at 30% over 10 years, it doesn't mean it's going to happen again. There's no guarantee that it's going to continue to do that. So those are kind of the 10, really 13 that we're covering here. I did wanted to show you this real quick. So you can see out of the consumer staples, you have, a handful. So you got Tyson, you've got Estee Lauder, you got Hormel, you got Kroger, and you've got Church & Dwight. Those are your consumer staples. For discretionary, you've got, of course, Nike, you've got Lowe's, you've got Marriott, you've got ROST, you've got Domino's, TJX, Home Depot, Lennar. So it's a good mix, 6 and 4. And then within the industries from the sector, you've got food products, you've got household durables, specialty retail, and this one is, obviously home improvement retail versus TGX. Specialty retail is more of discount, retailer for clothing and household items, same as ROST stores. And then Domino's, it says hotels, restaurants, and leisure, but it's weird, but it's restaurant, of course. And then with Marriott, you actually have the hotel, restaurant, and leisure, and the sub-industry is hotels, resorts, and cruise lines. But Nike, footwear, Kroger, of course, food retail, and you got the grocery side of it. Then Hormel is more of the packaged foods. Tyson's going to be more packaged foods, fresh protein. And then the CHD, the Church & Dwight, is your household products, kind of your staples. Costco is going to be on here as well. That's going to be a bonus pick that we'll cover in a minute. And that one would be a great staple, which gives you a little bit of a blend of retail, of consumer staples with, the Kirkland signature brand, as well as is kind of a membership subscription type model as well. All right, guys, time for some bonus picks. And as I mentioned earlier, this was a hard video to make because there were so many companies that could have been on here. And there's a lot of companies like Costco that I own that should have made the list. And I want you to consider owning Costco. The thing about it, though, is it's run up so much. I've owned this for 5 years. It's up almost 50% on the 52-week, and the thing's trading at a 37.76 PE ratio. I just don't think I would start a position at $322 a share. I could be wrong, and maybe it'll just keep going up and up and up. But personally, for a consumer staples type of a company, it's considered consumer staples. I would say it's probably the best consumer staples stock. I just don't know if I would open a position at 322. So I want to include this in the video because I think it's a good company. I think it's one that you should own long term. I'm just not so sure about the valuation right now. The dividend growth has actually been pretty good. Depending on what you look at for the payout ratio, it can be a little goofy, but the actual growth rate is good, 14%. It's really averaging about a 15% growth rate, and they've been doing it for about 15 years. So it's pretty good in terms of the dividend safety. This payout ratio is showing a 29.94, but you can look at other places and it's a different number. So Seeking Alpha is usually pretty good. If it is a 29.94, then that's not so bad. But nonetheless, the primary reason I didn't include this as an actual pick in the top 10 is just because of the valuation. So Costco is one to look at, though. McDonald's is another one that I would consider as a nice long-term play. The payout ratio on this one is a little bit high, though. It's about I think it's 63% or something like that. Dividend on it's 2.3%. Obviously, it's an aristocrat. They've been paying increase in dividends for years and years. It's not going anywhere. It's, in my opinion, it's a real estate play. I own a little bit of it. I bought it down here when it was 195 or whatever, so I'm up decent on it. McDonald's is one that could have been on the list. The payout ratio is just too high, so I eliminated it. The next one I wanted to cover, this is a really cool one, Churchill Downs. And so Churchill Downs, like, the racetrack, horse racetrack, but they also do online gambling. And the reason that this has gone up 72% over 52-week is because gambling has become legalized. So now people are doing sports betting and things like that. It has a very tiny dividend, which is why I didn't include it. It's only 0.36, and the dividend growth is over 10%, but I think it's like 11% on the 5 years. So nothing too crazy sexy with this in terms of dividend growth or the dividend actual yield. But it actually does fit the 5 metrics, and it's kind of a cool stock. So one that I could have easily included, but I decided against it due to that really small dividend yield. Another one you could look at is McCormick. They have French's Mustard and Frank's Red Hot, of course, with a lot of the younger, millennials and younger, they want to be health conscious. They don't want condiments that have calories. So ketchup, like Kraft Heinz has not performed well because of, ketchup has sugar, has calories, where French's Mustard, yellow mustard, no calories, has a little bit of salt, but it gives you a little extra flavor. Frank's Red Hot, same deal, a little bit of salt, but no calories. So, obviously they have a lot more than just those two products. They have spices and stuff, but that's one that you could look at. Tyson, we already talked about. Disney's interesting because it's actually considered communication services. Of course, now they have Disney Plus, but when you think of them as, Disney retail stores, you think of their theme parks, that's kind of amusement parks. To me, Disney could be either consumer discretionary or it could be communication services. It's technically in communication services, but I want to include Disney as a potential bonus play because I'm not sure Disney's going to make the technology and communication services video. There's just way too many other stocks in there. So look at Disney. Casey's General Store, depending on where you're located geographically, you may have no idea what that is. But where I live, there's a Casey's on every corner, basically. It's like a 7-Eleven of the Midwest. Casey's General Store actually has some pretty solid numbers. It was kind of surprising, actually. It was pretty interesting. Best Buy was one, but the thing about it is the 10-year performance was about 13%, so it's a little bit underperforming. And then I think the dividend yield on it was like 2.2%, but the growth was wasn't all that attractive. Target was another one, and I do own some Target. The dividend growth and the 10-year annualized really isn't very good. If you remember, Target had, and it could be one of those situations where Target could continue to do very well. Target's done very well over the last year or two. It's really kind of coming into its own, competing against Amazon. You remember they had some problems a while back with getting credit card information stolen. I mean, this thing's up 61%, and it actually was up even higher, and it took a little nosedive after earnings. But the PE is still pretty reasonable at 18, has a 2.26% dividend yield. But the dividend growth and the 10-year annualized were a little bit too low to make it. Another one you can look at if you're looking for high yield, because some people watching this video might be looking for higher yield than we've talked about at this point. This is Foot Locker, 3.76% yield. It's a 8.74 PE ratio. A lot of the hardcore DGI folks and the value investors talk about this one. It's down 31%, 52-week. Obviously, it's retail and they're in malls, and that's a dying breed. But they do they own like Champ Sports, Lady Foot Locker, Kids Foot Locker, Runners, Sidestep. They do sell online though. It's pretty undervalued, guys. If you look at really what you're getting at 3.76% yield. But of course, it's retail and it's been beat up with anything in the mall. No one wants to own it. I actually do own some Foot Locker, and I've owned it for a while. I'm actually still up pretty good on it. I bought this down here at like 30 when it dropped way down here. I bought like 29. I think my cost basis is $31. So, I mean, this thing has been as high as in the last year or two, it's been as high as 65, and now it's trading down at 40. Obviously, there's, China fears and things like that with the coronavirus and the fact that it's retail malls. Procter & Gamble PG actually has a bad dividend growth and not very good performance. So that's a super duper safety stock, and it really doesn't fit into the DGIF model, but it's something I wanted to talk about. There's other ones like Wendy's, Dunkin' Donuts. I could go on and on and on, but the 10 that we identified today, I think, are pretty attractive. Some of these bonus picks could be something for you to investigate as well. I appreciate your time. I appreciate you watching these videos. If you haven't stopped by the Facebook group, please do. We've got a group called Fired Up Wealth. Please stop by. There's a page. There's also a group that you can apply for, a private group where we have some additional conversations, a lot more in-depth Q&A, things like that. And if you haven't subscribed, I really would appreciate you subscribe. Hit the button on the bottom right. Hit the little bell for notifications. If you like the video, please hit the like button. I encourage you to comment below, ask questions. Thanks again for watching. Have a great rest of your day. Take care.